Let's take a look from a global perspective, what we're seeing both in the economy and markets. Kerry Craig joining us from JP Morgan. Kerry, welcome back to you. In fact, we've just got the latest inflation read out of the States, which pretty much came in line. Concern, of course, broadly on whether the Fed is going to have to hike again. But what are you seeing, and I guess particularly from an economic growth point of view?
Good morning, Andrew. Well, I think the growth outlook for the US is relatively intact. We've seen a lot of the more recent business survey data, whether it's the ISM numbers, the Purchasing Managers Index number, all be a little bit firmer, suggesting there's still momentum in the economy. And we're still seeing some sort of lingering effects from that fiscal stimulus that came through under the One Big Beautiful Bill Act, helped to offset some of the shock to households from the higher energy prices. Now that we have energy prices that are coming down, fuel prices at the pump, which are a bit lower, that should ease some of that pressure on consumers. And we have equity markets that are continuing to rise, which helps the top end of households in the US and does feed into that consumption story as well. So we do see a setup for a fairly decent pace of growth over the second half of the year. In fact, much better than we saw in the second quarter. And I think that obviously comes into line with thinking if there's still that demand in the economy, are we going to see those inflation pressures being a little bit stickier? And maybe see the Fed hike interest rates again. But, from the CPI numbers, unfortunately, there's not really much in there that's going to change anyone's mind, but it does show that at least that sort of same disinflationary impulse is intact, with prices coming down compared to a prior year ago by more than was in the prior month.
So, Kerry, as you alluded to there, vast amounts of capital flowing into that AI trade. Yet, more recently, I guess, there's been a bit of market pressure on those AI names. How do you see that playing out at the moment?
Been a lot of concern around just the level of capital investment these companies are doing, trying to figure out when that return comes through on that investment, and the market really trying to figure out, I think, two different questions that have two very different time horizons, which make it very difficult. The first question is, when do I see that return on all that investment? When do we think about those adoption rates kicking into gear across enterprises that really see that funnel into revenues and then back into hyperscalers justifying all the spend and then filtering throughout the AI supply chain across the world? And that's something that's hopefully going to become more apparent in the near term. And I think if you look at some of the earnings around the cloud that was reported in the US earnings season, there is some justification for that. The second question, though, is the bigger one, and I think it's the one that is the more difficult to answer. It's really, who's the winner? So which one of these perhaps hyperscalers is going to become more dominant? Which of the platforms, if it's the Chinese versus the US models, are going to become more dominant across business use because of the pricing for it? And then is it going to be businesses or the adopters that actually start to benefit more in terms of protecting margins and helping revenues? And that's got a very different time frame and a much harder question to answer. But that's the ones the markets are grappling with at the moment. And I think why you've seen some of that churn in terms of semiconductors, memory names, and hyperscalers and their performance. But underpinning all that, they've all had very good earnings, and I think that's really what's in focus. We're thinking about the market at the moment. Valuations are higher but not stretched, and so for us, it's again very familiar. Make sure we're exposed across that whole AI layer cake in terms of the infrastructure, the hyperscalers, as well as thinking about those model builders and app builders to really have the broadest exposure against what we think is a quite a strong secular theme, and those capex levels will continue to rise in the years ahead.
Now, Kerry, of course, there's been so much debt issuance to fund that AI build out. What are you seeing in the fixed income space at the moment, particularly given those tight spreads?
Well, it kind of makes sense for these companies to want to issue debt to justify all that investment, or sorry, to fund all that investment. They've just been doing it through cash flows, which has been fine. There was no market concern around when these companies were very cash heavy and can fund all this. But as those numbers have grown, because it's important to remember they're growing because there's underlying demand for what they're doing, they've obviously had to broaden out that and think about the best way to structure that across their balance sheet, and that is to go to the investment grade market. They initially were getting very high uptake of that debt. They were oversubscribed on a lot of the issuance. Those spreads were relatively tight, and so it did make sense. But now the market's sort of a bit more concerned around, again, some of those earlier themes around that return on investment. You've seen some of the spreads widen out a bit on a bit of this issuance. The oversubscription rates have fallen. So it's been a lot to digest in terms of the volume of this issuance from these hyperscalers in a relatively short period of time. And it's been a bit surprising. I think once you start to see the issuance become a little bit more structured, a bit more confidence around that earnings outlook, which is so important for the fixed income side as well as the equity side, it'll become easier for the market to digest this as another way to get exposure further up, the capital structures and equity to these names overall. But I think the issue really is from a portfolio construction point of view. Now we have some concerns around concentration risk in equities, correlations between emerging markets and developed markets becoming closer because of the supply chain story across North Asia. And now thinking around how some of that concentration risk and AI theme is coming into the fixed income market, it's really a case of saying, how do I ensure I have a robust portfolio that has other exposures in it that doesn't need me sort of singly exposed to this one AI theme, just in case everything starts to unravel. And so that's where we look towards more private markets in terms of thinking about differentiation to public markets and trying to build in, again, other sources of alpha income and diversification into a portfolio.
What are you seeing with treasuries at the moment? I guess particularly in the wake of that latest inflation read out of the States, you mentioned where economic growth is, and also your view as to what you're seeing in other developed markets, particularly in Europe.
Yeah, looking this morning, US 10-year Treasury is around 4.7%. It's probably near the upper range of what we think would be a good value. So if that Treasury pushed towards 5%, there'd be, concerns around the reason for it doing that, or if it's more inflation or some fiscal concerns. But if it started to nudge a little bit higher, I think it becomes a little bit more appealing in terms of generating a good income and our view of the Federal Reserve largely being on pause and not hiking rates at the moment because the market the economy doesn't really justify it. And thinking about some of that yield falling on that basis. Also thinking about inflation that will continue to ease in terms of those pressures, so suggest that we should see those yields come down as well. However, that does come with a lot of risk at the moment, given we still have that conflict in the Middle East, as well as thinking about the reaction function from the Federal Reserve. So if we were to take the duration exposure at the moment, it would be outside of the US. We'd be looking towards economies where they've become a bit more fiscally responsible. So that is markets like Italy. They have learned, not the lesson, but learned the experience from thinking about the European debt crisis, looking to markets where there'd be a greater growth shock should that Middle East conflict start to reignite itself in terms of further pressure on energy. And that is, again, Europe. And so we could see more consequences for yields coming down there. A central bank that was more likely to cut interest rates in that environment, and again, taking duration exposure in that market. So overall, we'd be fairly underweight on duration still, but more selective around the world and how we take it and preferring the non-US market. I think Australia looks appealing as well, considering you have a 10-year at 5%, and we don't expect the RBA to do anything on rates from here. And in fact, we'd expect the next move to be easing in 2027. So I think you're picking up pretty decent income at a time where there does seem to be little risk around too much inflation or further rate hikes in Australia.
And Kerry, overall, what do you see as an appropriate portfolio asset mix at the moment?
We'd be biased towards having more risk exposure in a portfolio. So decent economic backdrop. We think that central banks have come to near the end, not likely to see a further prolonged rate hiking cycle, which would crush the economy. We're seeing earnings growth that's fairly robust across both the US, Europe, and across Asia. So it's a good setup for thinking about global equities. So we'd definitely be leaning in towards equities in this environment, wanting to balance that out with, again, exposure around this AI secular theme across all levels of that layer cake. And then looking at some of the more cyclical parts of the market as well. So, for example, financials, parts of the industrial complex that aren't AI related, which are doing quite well. And then again, broad diversification across Japan, across emerging markets, and across the US. So it is, again, about thinking of the balance in a portfolio, but maintaining that risk on exposure. And similarly, wanting to take that through the credit markets at high yield, where all-in yields of 7% are pretty attractive and default rates remaining very low, given the strength of the earnings outlook and the strong balance sheets of companies. So we wouldn't need to see the pressure to become more risk off in this environment at all. We think there's a very low chance of recession and earnings are really going to hold up. We just want to see that broaden out a little bit in terms of corporate performance away from just these AI and AI adjacent names.